Welcome. My name is John Elpers, and today we're going to be talking about finance and financial management. I'm faculty member here at Tennessee Wesleyan, and this is an intro course for you on dealing with finance. What we'll be dealing with today is, to start out with, we're going to be dealing with Chapter 1. Chapter 1 is learning about the intros of finance. So in order to talk about finance, what is finance? What does finance mean to you? Finance is what we do with money, not only money, but the decisions we made related to money. It's how money is raised, how money is used, how do we go about getting more of it when we need it, and is it worth the expense that we have? Is money free? Normally money costs you something in order to get, do people put a value on money to the point that if they're going to give you something now versus if they're going to give it to you a year from now, is there a value related to that? All those different kinds of things we're going to be talking about. Obviously, when you're dealing with finance, you're going to be dealing with the situation where more money is better. We want to have more value. We want to have more financial value than less. So the sooner cash is received, it's going to be worth more to us. So the longer it takes me to get that, I'm going to want a premium in order for you to hold on to my cash for a period of time. All of these things feed into the fact, what do organizations and what do individuals need, want, and require in order to deal with finance? So you would also expect, the last thing they talk about is, if something is riskier, you would expect that you're going to get a higher rate of return, because there's a chance you might get no rate of return, or you might get a negative rate of return. All of those things couple into whether or not the value that you're going to put on different instruments. So the general areas that we're going to be talking about is markets and institutions, investments, services, and managerial finance. We'll be discussing all of these different topics throughout the entire course, but the majority of, we're going to highlight a lot of these things during this first chapter. Okay? From the way that finance is usually depicted in an organization is, there's a couple different ways. You see now that there will be vice president of sales, and there's a lot of crossover between these areas and a lot of different departments. Sales needs to know information from the finance group to know how much they can charge, to know whether or not they're meeting their budget, whether or not they're doing the things they're supposed to, and it goes through the entire organization. My background is that I was an accountant for almost 30 years, so obviously finance is very important to me. And what I've found is that you are in charge of creating the financial statements for the organization, but at the same point, the value that you add goes way beyond just creating income statements, balance sheets, and the such. It goes to whether or not you're making money doing a particular project, whether it's a good idea to do a particular project, or whether it makes no sense to do that kind of stuff. All of those types of things go into really being a financial professional. So, in order to start with this conversation, we have to start with the different types of organizations that people have. Now, there's essentially three. Some people will call it four, but essentially there's three. You have sole proprietors, you have partnerships, and you have corporations. There's differences and there's characteristics with all three of them. There's good and there's bad to all three of them. The main difference that you're going to find is sole proprietor usually has all of the liability, which means if things are very good, they get all of the profits. Whereas if things are very bad, they're the ones that are going to lose all kinds of money, and they could lose all of their personal property as well. As you go down the continuum, partnership, you're now sharing it with somebody else. You're sharing some of the liability. And when you go down to corporations, there technically is no individual personal liability. We'll talk about that in just a second, because the environment to that is changing. It's going through some changes based on some recent legal things and some recent things that have happened. Okay, so that's one of the main things related to the organizations, is liability. The other is the ability to be able to raise capital. Capital is what we use in order to buy stuff, to get things. If I'm going to raise capital as a sole proprietor, the only place I can get capital is from my sole proprietor. So if I need more money, if the organization needs more money, I can ask my owner, please give me some more money. On the converse, Partners, I now have multiple people that I can ask or tell them that I've got to have some more money in order for the operation to go. Go down to corporations, I've got a ton of people. I don't have to just ask any one individual. I now have my ability to raise capital has increased quite a bit because I'm not limited to the number of people that I can deal with. Those are the main two differences. We're going to go through some other characteristics related to proprietors, partners, and corporations, but those are the main two ones. Now, there's also hybrids related to this. Before we get into the hybrids, let's get into what the individuals are. Here's proprietorships. Ease of information, unlimited, they're subject to few regulations. Basically what this is if you talk about what does it take to open up a proprietorship, you can just say, I'm open. There's a website called LegalZoom.com, and you can actually use that and set up a proprietorship in about 5 minutes. About 5 minutes. It's not that much longer for the other one. There's just a lot more legalities in order to do some of the other things. Okay? Limitations is that when the individual passes away or the sole proprietor goes away for whatever reason, the organization ceases to exist. It is no longer there. The limited life, transferring ownership usually means the one proprietorship ends and a new one begins. All of those type of things are very specific, and it can be a limitation to proprietorship. The partnerships, the only difference is now you've got 2 or more partners. And there is some legality changes, some legal changes that have been occurring to here. It used to be that the partnership is roughly the same advantages and limitations as a proprietorship. And what used to happen is, let's say that you had a partner, one of which had really deep pockets, the other one didn't. Well, when they took all of the assets of the one, they would go after the other one only up until how much they owned of the organization. Well, that's starting to change, and now if you're a partnership, we're going to see a variation of partnerships in just a second. It is not protection to be limited in the partnership because they can come after your assets just as much as they could ours. So the example I used before where the one has limited resources and the other one has deep pockets of your partner, they can come after the partner with deep pockets for everything that the partner has, which could be a lot more money than the one who doesn't have a lot of resources. So roughly the same as a proprietorship, but there are subtle differences. Corporation, unlimited life, ease to raise capital, cost of setup, reporting, filing, and being that a corporation is considered a separate entity, it is an entity just like you and I from a tax standpoint, which means there's double taxation. Anything that happens that is going to be taxed, the corporate profits are going to be taxed at the corporate standpoint, and when they distribute it to their owners in the form of dividends, will be taxed to us, the owners, as well. So there is double taxation based on their profits. The hybrid forms I referred to earlier are limited, they're called LLP, LLC, and S corporations. All of these are basically limited liability. They have to do with partnerships. This tries to be a little bit more of a corporation, and the LLP tries to limit the amount of liability that an individual partner has. Well, I just said a couple minutes ago that we're finding that doesn't necessarily happen. And what we're finding is that even though the partner might say, I'm limited, and I've signed an agreement saying that there's only so much you can come after me for, the courts are saying, no, if it looks like a partnership and walks like a partnership, guess what? We're coming after all of your assets. So unless something changes drastically in the courts, we're seeing that more and more people are being held accountable for that. S corporations are essentially the same as it tries to provide some liability comfort for people that look like a proprietorship. And again, the courts are coming into some scrutiny on this right now because they're saying if you look like a proprietorship and you walk like a proprietorship, you probably are, which means we're not going to let you keep your assets away from your creditors and say that they're not that they can't come after those if you had debts that you owed. Okay? The goal of the organization, the intent of any organization, especially corporations, should be to maximize your value. Increasing shareholders' wealth should be at the utmost of anything that you do. All types of information should get you to the point when you are, all types of activities should get you to the point where you are trying to maximize the value for the organization. Now, what that means is that you need to act in the best interest of the organization, whether or not it benefits you personally, whether or not it benefits your friends, your relatives, whatever. It should be the organization first. Organization first. Goals: maximize stock price, which is shareholders' wealth. That is shareholders' wealth. You want the goals, you want the incentives of the managers to be in sync with that. What you don't want is to have incompatibility between the goals of one group versus the goals of the organization. Because there are many times that a lot of places and a lot of people are set up, and they have certain sales goals that they have to do. Well, if the sales goals are met, what is their incentive to do any more than the sales goal? When that occurs, it becomes a big problem for the organization, because their incentive, the managerial incentive, stops. So why would you do more sales? Well, you know that you're doing it for the good of the organization, but you have to make the incentives tie in to the organizational goals. And lastly, corporations should have some social responsibility. You shouldn't do things like ruin the environment. And the way that people hold themselves or hold corporations responsible is by the stockholders saying, no, you can't do that. I'm the owner of this place, and we don't like the fact that you're dumping waste, or something akin to that. But there should be some social responsibility. Okay, the ways that people go about maximizing the shareholders' wealth is by coming up with the best capital structure possible, sound budget decisions, and making sure that your dividend policy decision is appropriate. Dividend policies are a big issue for organizations, because a lot of people will set dividend policies that their investors want to see that can actually be a detriment to the organization. I'll give you a good example. There could be organizations that say, our dividend policy is I'm going to pay out $1 million a year, every year regardless. The investors look at that and say, hey, I am guaranteed that I'm going to get some type of a return. Well, if the organization has a very good year, you're limiting yourself to $1 million. What if you could have given them $10 million? Okay? You can still increase it based on that type of scenario, but what you're doing is you're setting your bar a little bit too low. On the converse side, what if your organization had a bad year? You promised all of your owners, all of your stockholders, that you were going to pay out $1 million. Your dividend policy says, every year I'm going to pay out $1 million. What if you don't have it? Then the next thing you know, organizations are borrowing money in order to meet a commitment that they really can't afford. At that point in time, they call them very restrictive dividend policies, and there are companies that can actually go under because they borrowed so much money in order to pay a dividend that they couldn't afford. So dividend policies are a big issue to organizations, and it's something that the organization really needs to think about before they set too high of a goal. Investors love to see the fact that you're giving them a good rate of return, but you've got to think of the organization, and sometimes it's better to set the initial policy, the dividend policy, a little bit lower, and then give them more money. So when the organization does well, the shareholders do well as well at the same time. If you don't do it, you can actually hurt the organization. So the value of the firm is basically determined by these factors. What is the normal cash flow that I'm going to get? What is the normal return that I'll get? And take that to the present value. Take that to today. So I look at all of the economic conditions, government regulations, competitive environment, and I can put a value to that for individual organizations. All of these, the end result is the value. Everything that I do should be trying to increase that value and trying to increase the value associated with this. So the way that managers can influence this and affect the stock price is by cash flows, timing of certain payments, estimating the risks associated with the cash flows, my use of debt, and again, I talked at length about the dividend policy. in conjunction with this, organizations have to worry about agency relationships. The whole concept of agency has to do with whether or not everybody is working in the best interest of the organization or themselves. The example I used just a second ago talked about a sales group that had met their sales quota. Well, the agency agreement would say if you were working for the best interest of the organization, you would continue to do sales even if you didn't benefit personally from that because you're doing what's in the best interest of the organization. Well, most people will do what's in the best interest of them. Not necessarily at the detriment of who they're working for, but if they have the choice. I had a situation in my experience where I had somebody a salesperson who was meeting a sales goal, and what they did was they held the sales to the next month in order to actually maximize their chance of getting their highest bonus. So once they hit their sales limit, they would actually hold off on the sales. They didn't stop doing sales, they just didn't process the sales until the next month. Now, is that in the best interest of the organization? Probably not. But I can understand from a human being standpoint, if you were going to get paid a bonus and you knew you could hold these sales a couple days, maybe 3-4 days, and have them count toward next month, you will benefit more from the fact that those sales are helping your next month. That's where agency becomes a big problem, is you've got to make sure everybody is working toward the same goal, and it doesn't always work that way. Stockholders versus managers. Sometimes the stockholders want money back. There are certain types of stockholders that want to receive a certain rate of return. Well, I just talked about dividend policy and how that can be very restrictive. If the stockholders want you to do something that's going to get a very quick return, but you can see long term that it's going to hurt the organization, that's where managers have a real problem. And one of the issues that comes up is profits are foremost for most organizations. So a lot of places and a lot of organizations will forego streamlining, advancing and increasing technology, buying new plants, because all of those things cost money. So what they'll do is they'll actually let some of their machinery get old, not go to the latest and greatest technology, so it maximizes profits. But what it's doing is it's allowing old technology to be there, so 5 years down the road, they're so far behind their competitors, they'll never catch up. So there is a trade-off that has to happen, because sometimes the stockholders don't always see what's in the best interest of the entire organization. And sometimes the pressure that the stockholders put on the managers will force them to do things that are not in the best interest of the organization. So managers and upper level management has to step in and say, nope, this is what we have to do. This is the way we have to do it. So business ethics. We always talk about ethics, and basically it comes down to, are you doing things that are in the best interest of everybody? Attitude, conduct toward its employees, customers, community, and stockholders. The term that's used a lot of times and sometimes misused is called stakeholders. Stakeholders have more than just the stockholders in mind. They're dealing with everybody that an organization touches. There are huge industries, the auto industry, for example. They don't just deal with people that are buying and selling automobiles. You have rubber manufacturers, you have glass people, you have all metal. All these different organizations are stakeholders related to the company, related to the actual company. And the point in all of this is your governance should be set up so that you're doing what's in the best interest of all of your stakeholders. If everybody benefits, everybody will see good things come from the organization. The rules and actual bylaws and guidelines that the organization lives off of is going through a lot of scrutiny, and has for quite a few years because of some of the Sarbanes-Oxley. You'll also hear it referred to as the SOX Act. What happened was there was a period of time when people did things wrong. They just flat out were manipulating financial statements, saying the wrong things, and what it was doing was it was causing investors to do things that normal routine investors would not do. Information was being given to them that was wrong, so the government got involved, did this act, SOX Act, which now forced the organizations to be a little bit more responsible. Now, go way back to the very beginning of this discussion when we were talking about the 3 different business organizations. One of the things we said was that we said that there's limited liability with corporations. Well, what we're finding is that that is changing quite a bit. Limited liability means that I only have liability to what I own in that organization. Well, corporations are now making the CEOs and the CFOs personally sign off on the financial statements so that if something is wrong, materially wrong, that caused investors to make a bad decision, they can now sue the individuals. And CEOs and CFOs have personally gone to jail for the fact that information went out. I'm not saying that's wrong, I'm just saying that's a change. So when you tell those individuals that there's limited liability, they'd probably say, no, not so much, because I'm going to jail for the fact that information was wrong. So limited liability is somewhat subjective now with the advent of the Sarbanes-Oxley Act. Okay? Other forms of businesses in other countries, different countries do things differently, and what we're finding is that a lot of them do their accounting differently. There's something called IFRS, which runs the rules for international accounting, versus good old USA accounting is generally accepted accounting principles, GAAP. As of this date, there is one country that uses GAAP, and that's the United States. The rest of all of the organizations use IFRS. What that means is that in order for us to be able to deal in other countries, we have to do some different types of financial information. It's not different, it's not wrong, it's not bad, it is just different. It's just a little bit different from the way we do things. But it's different enough where it will give you different results. Therefore, comparability is a problem. Comparability is a problem. A lot of people are looking internationally because it's so easy, and it's so, like if I wanted to trade stock on the Japanese market, I could go on the internet and a couple clicks of a button, I'm there. All of these things, the reason they're doing that is all of these new markets, all of the new technology, all of this is forcing and opening up markets for us. So anything that I can do to take my business and increase the size of it and increase what that business will do helps the organization. Remember, maximize shareholders' wealth. That's what I'm trying to get to, and the ability to be able to do this just helps the entire organization. So, a lot of the other issues that you have to deal with from a multinational organization is you're dealing with different currencies, you're dealing with different laws, you're dealing with language barriers. There's a lot of cultural differences. Things that we take as very common in the United States could be very, very bad and people could look down on you in different countries because you do different things like that. There's also political risk. There were organizations in the late 2000s and even in the 2010s where organizations in third world countries, the governments were saying, we are now going to take your businesses. Well, that threat of business coming in there is a political risk, and for some cases, if they're coming in and taking your whole plant, your whole facility, that's a pretty large risk to go into in order to go do some work in that country. So, but you take that risk from a business standpoint because you think that it's going to help your business to do that. Okay, all of those things add into the complexity of doing international business. This is the end of Chapter 1.